One of the other advantages that everybody talks about 401ks having tax deferred growth, and they look at that as an advantage that's almost specifically for the 401k, like other plans or other products don't have that same benefit. But I think it's important people know one of the advantages of both permanent life insurance and 401ks is that they both provide that tax deferred growth. What that does is it allows your money to accumulate without immediate tax implications. So you're going to pay taxes on that money when you take it out later in life. The difference is life insurance takes that benefit to a whole other level. Like it adds an additional step that enables you to access the growth tax free, which is a significant advantage that isn't available in a 401k. In a 401k, you enjoy the benefits of that tax deferred growth, but any withdrawals you may make in retirement are subject to income tax. And that means that you start taking distributions, you owe taxes on the entire amount of the distribution that you took out. And it significantly reduces your retirement income. And it's something that people don't think about. And depending on where your income is at the time that you withdraw the funds, it may even shoot you into a higher tax bracket. And that could lead you to an unexpected tax burden, not only federal, state. I mean, your taxes could just possibly increase. Controversially, with permanent life insurance, the cash value you accumulate over time is not without tax. You pay tax on that money immediately, then you allow that to accumulate. But more importantly, you have the option to access that cash value through the policy loans. So that allows you to utilize the growth for various needs, whether it's funding retirement expenses, making a significant purchase, or managing any kind of unexpected financial challenges that come up on a day in and day out without any immediate tax consequences. So if the policy remains in force until the insured's passing, Ron, you just talked about it, the death benefit gets paid out tax-free to the beneficiaries, and it provides another layer of tax efficiency. And that combination of tax-deferred growth with the ability to access funds tax-free makes permanent life insurance a compelling financial tool.
Yeah, I think that's, when you're talking about tax deferred growth, that's kind of one of the main selling points of a 401k is that you don't have to worry about you're setting it aside, you're saving money, and then, you're deferring taxes on that and you're not paying taxes even up front. So that's what we talked about earlier is it's reducing that adjusted gross income for that year, which is a wonderful thing for your current calendar year when you're talking about that deferral in a 401k. But the bigger piece of that is what does that deferral mean at the end? And that's when we're talking about, the difference between a 401k and a policy like you're describing is that policy doesn't have, it's a tax deferral, but it's also an entity at the end where you go to take cash out and you don't have to worry about taxes in the future either, or even short term, because now we don't have that 59 and a half rule that we talked about earlier coming into play either. So that deferral is important, but it's also understanding how does that deferral act at the end. And with a policy, that deferral at the end means there's no tax implications, whereas a 401k, all of it is taxable when you go to take distribution. So that's a big factor in terms of looking at this kind of as a side